Shift our focus to some important earnings we are tracking today. Tata Steel reported a good set of fourth quarter earnings. My colleague Nigel D'Souza caught up with TV Narendran, who's the MD and CEO of Tata Steel, to discuss their quarter four performance and began by asking if there was any one-off in the EBITDA numbers for India as well as Europe. Listen in to what he had to say.
Operationally, we were strong. I think particularly the Indian operations delivered its highest ever production numbers. And deliveries were also strong, higher than in Q3 because the market sentiments changed quite a bit. Nothing very significant, in terms of one-offs up and down. There are a few which, in some sense, cancel out each other quite a bit. We were obviously helped by the price increases in India, the volume increase in India. Coal prices settled, though we've not yet fully got the benefit of today's coal prices, which will come in the next quarter, not in this quarter. So that's the story as far as the EBITDA is concerned. In Europe, I think the costs were actually slightly higher than what we had thought. The prices were okay, volumes were okay, but as you know, we're going in for a major blast furnace relining. One of the blast furnaces is down, so which will be back only in August. So we had guided last quarter as well that the European challenges will continue for at least another quarter till our blast furnace comes back in August.
All right, Mr. Narendran, you briefly mentioned about coking coal, and that's going to be the joker in the pack because that's cooled off quite a bit. Tell us, what was the coal consumption cost in the past quarter, that's in quarter four, and how do you see that average in the first quarter of this new fiscal?
So I'm not remembering the exact numbers of coal consumption cost, but this quarter will be about $10 higher than last quarter, consumption-wise. So the procurement may be about $25 to $30 lower in this quarter, but we will get the benefit of that only in the next quarter. So that's why this quarter margins will still see higher coal prices than the spot coal prices because we are getting what we bought 3 months back. And coal prices started dropping more in the last 30 days.
Okay, so the benefit of the lower coking coal cost will actually come in the second quarter of the fiscal, while quarter one will see higher effective prices on the coal side. That's an important clarification then. So let's compare pricing then. In China, in the last 20 days or so, prices have come off considerably. I'm tracking the HRC prices out there. They're down between $70, $80 odd. Now, the street is bracing that in India as well, we could see lower prices in May. So what is your estimate? Will there be a price cut here in India? And, if you could tell us as well, what could the quantum be?
I won't talk of the price cuts month on month, but quarter on quarter, we expect prices this quarter to be about 1,200 rupees higher than last quarter. Okay, so that's our assessment. Yes, China has softened, but let's wait and see what happens next week after the holidays are over.
All right. Could you compare then domestic prices with imported steel? What's the price as of now? The difference?
So domestic prices are in the 60,000 range for HR. Imports, you keep hearing, nothing major has come as yet. Some bookings are there. But even if something comes, it's 200,000 in a market which consumes 10 million a month, So yes, it will hurt sentiment a bit. Steel business is a bit sentiment driven. If people think steel prices will fall, they postpone purchases. If they think it'll go up, they advance purchases. But I think we look at the fundamentals, and I think the fundamentals for India are still quite strong. I think pretty much auto industry, commercial vehicles is still very strong. Construction is got enough order books. If you look at pre-engineered buildings, they're all sitting on 4 to 6 months of order loads. So I think demand is fundamentally strong. Prices will reflect a little bit more international sentiment and stocks of traders.
But you're not giving us a difference, sir. What's the difference between domestic prices as well as imported steel? Is there a difference, or is it pretty much?
I think today, if you're exporting steel into Southeast Asia, you're selling at maybe about $620, $630. You're selling into Europe, you're higher. So, I mean, there are lots of quotes going around saying that in Southeast Asia it's available at $620, etc. But so you can do the math there, and of course factor in the risk that you would take because you buy today, you'll get it after 2-3 months. So, this difference is always there, right? I mean, nothing new. Okay. In any market, the domestic prices are at a premium to international because there's always a risk when you buy international.
Okay, all right. What about spot EBITDA per ton? Now, India looks splendid. You know, Mr. Narendran, I go through all the analyst expectations on the sell side, and no one was even close to the 16,500, 16,800 rupees per ton that you've delivered. So, how is the spot EBITDA per ton looking in comparison to what you've delivered in the past quarter, both for India as well as for Europe? Will Europe losses be in this vicinity of around 90 to around $100 per ton for a couple of quarters more, given that you have a shutdown? And for India as well, how does it compare?
So if I look at Europe, we see the situation in UK improving quarter on quarter because of the fact that gas prices, electricity prices all are settling in. We do have some hedges in Europe on gas prices, which helped us when gas prices went up, which will take a couple of quarters to unwind when gas prices go down. Netherlands, you will not see the benefit so much because, like I said, half the production is down because the blast furnace is down. And whatever sales you're doing is using slabs which were made a few months back, you know, because we had stocked up on slabs because the blast furnace shutdown was going down. So I don't see things improving very significantly in Europe. It will not get worse. It may get marginally better, but we will start seeing the benefits in Q2 rather than Q1. As far as India is concerned, spot EBITDAs just now are, I would say, slightly lower than what we've announced for a simple reason. This quarter, we've had a lot of shutdowns. We will have a lot of shutdowns. April, June is when we take a lot of our shutdowns. So if you look at it from a cost point of view, the cost per ton tends to go up because you have lower volumes. The fixed cost gets apportioned over lower volumes. Coal prices are still higher. Like I said, it's about $10 higher than consumption of last quarter. So there will be those pressures, and steel prices, let's wait and see what happens in May and June.
Okay, what about the negotiations with the UK government? Is there a possibility of any kind of shutdown, or where have those discussions reached?
Well, the discussions are going on. I can't say that we made much progress beyond what has already been covered by the media.
Before we let you go, a couple of details more. Debt reduction came out of nowhere. Was that because of working capital release? If you could tell us that. And if that is the case, then we could expect some more release in the coming quarter. Give us a broad guideline about how much lower can debt be, say, in the first quarter, and for the year as well on the whole. What's the guidance?
So I think for the year, we are certainly targeting $1 billion. That has been our goal every year. We didn't meet it last year.
Yeah.
We did better than that in the previous years. So this year, we're back to that goal. And I think we should be on track for that.
If you're bidding for a new unit, if you're looking at inorganic growth, what is the rough number you'll be paying on a million ton basis, per million ton?
No, I think inorganic growth, we will hold on. We'll wait and see. Because like I've said before, with the existing sites, we have enough runway to expand to 40 million tons. So we don't really need a new site to go to 45 million tons.
Right.
So we will evaluate yearly based on attractiveness of asset and value of the asset.
You know, Mr. Narendran, you normally tell me this, but then you go aggressive as well. NINL, you just picked it up out of nowhere, and you've paid pretty much top dollar for it. And I'm asking you about inorganic growth because NMDC steel plant is definitely on the block. Have you made some progress out there? Have you submitted a bid?
No, we haven't. For NMDC, we haven't. Neelachal was different because we've always said that we were interested in long product asset.
Yeah.
And Neelachal was a long product asset. It had 2,500 acres of land next to our existing site. It had 150 million tons of iron ore. So we didn't value it as a 1 million ton steel plant. We valued it for its entirety.
That's the big corporate conversation for the day. Get into a break. On the other side, we'll focus on Blackstone-backed Nexus Select Trust, which is all set to launch India's